Hey everyone, today we're diving deep into what's shaping US retail in 2025, from demand trends to supply constraints and a wave of closures. Whether you're a landlord, investor, broker, or developer, this episode is all about helping you see what's really happening behind the numbers so you can make smarter decisions and seize new opportunities in the retail real estate space. Let's start with the big picture. Retail entered 2025 with serious momentum. Vacancy rates across the country are hovering near record lows. Multi-tenant retail space is sitting at just a 4.3% vacancy rate. That's historically low, and overall retail is just slightly higher at 4.5%, which is still well below the long-term average. And rents, they're still climbing, albeit more moderately. We see just a 0.1% increase quarter over quarter and 1.9% year over year. But the upward trend continues, and that steady pace may actually point to a healthier, more sustainable leasing market. Here's where it gets really interesting. New construction is not keeping up. The retail construction pipeline is only at 0.6% of existing stock, essentially a tiny trickle. That limited new supply, paired with a ton of retailers announcing expansion plans for 2025, sets the stage for continued demand and stability. Retailers aren't just talking about growth, they're acting on it. Now let's talk about demand on the ground. Foot traffic is up. Fitness centers saw a 5.7% boost. Restaurants increased by 3.8%. Even supermarkets saw a rise of 1.0%. Spaces aren't sitting long, and on average, vacancies are filled in just 9.3 months, and about a quarter of spaces are being leased in 3 months or less. Plus, tenants are committing to longer terms. Lease terms are now averaging 5 years, up from the historical average of 4.4. And that's great news for landlords seeking more predictable cash flow. Now, if we zero in on multi-tenant retail, specifically strip centers, they're leading the pack in terms of activity. In 2024, strip center net absorption totaled nearly 2 million square feet, but not all multi-tenant centers are equal. Community and neighborhood centers actually saw negative net absorption. So right now, the winners? Smaller, convenience-oriented retail. So why is that? Likely a shift in consumer behavior. People are making more frequent, smaller trips, and essential services, food, and fitness, these are the categories really thriving. Lenders, by the way, aren't too spooked by the recent headlines of store closures. Thanks to strong fundamentals, low vacancy, and tight supply, they're still lending. They just might expect higher reserves for tenant improvements if you have vacancy to fill. On the investment side, multi-tenant shopping centers attracted major attention in 2024, making up 42% of CRE trades in the $1 to $10 million range. And that's huge. Private buyers in particular are jumping in, especially those doing 1031 exchanges, looking for stable income. And yes, location still matters. In 2024, the Midwest was the only region where retail vacancy actually declined. Phoenix, Raleigh, and Miami had record low vacancy due to limited construction and strong population growth. Dallas-Fort Worth had the largest pipeline of construction, but absorption is lagging slightly. And Kansas City is benefiting from corporate investment and job growth, pulling investors downtown. On the single-tenant side, demand is focused on food-related uses, fast food, supermarkets, convenience stores. Vacancy in these categories is between 1% and 3.7%, but headline vacancy rates are being pulled up by empty drugstores and department stores. Still, private capital is active here, especially in that $1 to $5 million range. Think triple net deals with national brands and long-term leases, especially in high-growth markets like the Sun Belt. So let's touch on capital markets. Retail investment volume jumped to $36.8 billion in 2024, a 6% year-over-year gain. The average deal size hit $20.2 million, the highest in 12 years, with a surge in large portfolio trades. Borrowing costs are mostly ranging between 5.25% and 7%, with non-recourse debt available for stabilized grocery-anchored and strip centers through life companies. CMBS is still the go-to for value-add and interest-only deals. But it's not all smooth sailing. There's still economic uncertainty. Consumer strength remains solid, but inflation is sticky. And now tariffs on imports from China, Mexico, and Canada could weigh on GDP. Minimum wage hikes are increasing costs for retailers, and international tourism hasn't bounced back yet. But the return to office trend is helping boost weekday foot traffic in urban areas. Now let's address all those headlines about store closures. Yes, over 9,900 closures were announced in 24 and 25, but we also saw over 7,700 openings. And behind that churn are trends. Expanding categories include fast casual and QSR restaurants, discount stores like Dollar General, fitness, and healthcare. Among them, shrinking categories are drugstores like Walgreens and CVS, discount apparel, some dollar store brands like think Family Dollar and Big Lots. Now, up to 140 million square feet could be freed up from closures, but that's both a challenge and an opportunity. One of the biggest structural shifts happening right now, for the first time ever, service-based tenants are expected to lease more space than goods-based tenants. And that includes food and beverage, fitness, and healthcare. And those big department store spaces, they're being filled by everything from Netflix House to RH to Dick's Sporting Goods and even off-price retailers. So what does all of this mean for you? Vacancy remains low, especially in multi-tenant retail. Strip centers continue to outperform. Service-based tenants are reshaping the landscape. Private investors dominate the single-tenant space. Capital is available, but underwriting is tighter. And regional knowledge is more important than ever. And so that's a wrap on this deep dive into the US retail outlook for 2025. If you found this helpful, make sure to subscribe, share it with someone who needs to hear it, and reach out if you're looking to explore opportunities in your local market. I'm Kang. Until next time, stay sharp, stay informed, and stay in the game.